Every forex trader has heard this advice. Always check the economic calendar before you trade. But the real question is, do you actually know how to read it and interpret what it means for the market? Because understanding the economic calendar isn't just about looking at red or green numbers. It is about knowing how those numbers move currencies. The economic calendar is basically your roadmap of upcoming market events. It lists key data releases like GDP, inflation, employment, and central bank decisions, all of which impact currency strength. Each event has three values: previous, forecast, and actual. The previous number shows what was reported last time, the forecast reflects what analysts expect, and the actual value shows what really happened. The reaction in the market depends on the difference between forecast and actual. If the actual data is stronger than expected, the currency usually strengthens. If it's weaker, the currency often drops. But it's not always that simple. Sometimes how the market reacts depends on what it was already expecting. You'll also notice events marked with color codes, like yellow, orange, or red, which show their expected level of impact. Red means high impact. Those are the events you really need to watch. Think of news like the US non-farm payrolls, CPI inflation data, or central bank interest rate decisions. They can move the market within seconds. Medium impact events like retail sales or manufacturing data might create smaller waves, while low impact news usually doesn't move the market much. Now here, S, where most traders go wrong, they only look at the data after it's released. Smart traders plan before the news drops. For example, if you know the Federal Reserve is announcing interest rates today, you already know volatility will spike. That means you can adjust your position sizes, tighten stop losses, or even stay out of the market completely if you don't want to take unnecessary risks. In forex, timing is everything, and the calendar gives you that timing in advance. Interpreting the data also means understanding the story behind the numbers. A rise in inflation might seem positive, but if it pressures a central bank to raise interest rates, it can boost the currency even more. On the other hand, weak employment numbers might signal a slowing economy, pushing traders to sell that currency. The key is to connect the dots, not just react to headlines. So before you trade any pair, check what's coming up on the calendar for that day or week. Look at which currencies are affected, what the forecasts say, and what traders are expecting. That few minutes of preparation can protect you from unexpected volatility and help you take more calculated, confident trades. In short, the economic calendar isn't just another tool. It's your trading compass. It helps you navigate market uncertainty, anticipate volatility, and trade with awareness instead of guesswork. Remember, professional traders don't predict, they prepare.